All right, welcome back to order flow. So, previous video, again, we touched on market structure. Which foundational level is linked to market structure? That was the number 5, the entry pattern, right? That is where your market structure is going to happen. You only look at market structure on which time frames, on the daily and below, because they are confirmation. They are for your confirmation. So you use market structure when you are looking at an entry pattern, at a potential entry pattern, which means that we first need to have that boundary. Now we are going to touch on order flow. Order flow is a little bit more in depth on what you can expect and where you would potentially look to enter as well. Where order flow is responsible for your entry pattern and your risk management as well. Risk management is going to be a separate video, but understanding order flow is when you will also understand risk management. So where market structure only was responsible for your entry pattern, really, that is where order flow is now responsible for foundation level number 5 and 6. So this right here is where we first need to go over a few things, of course. We first need to go over, in the top right, we can see bias, narrative, boundary, and target, because that is when we get to entry pattern. That is when we get to risk management, etc. So that is where the lower time frame order flow comes in. The higher time frame order flow, what we saw, can be used as well for your bias, narrative, boundary, target, which leads to that order flow itself can be used for basically all the foundational levels. That is also why I love order flow, because order flow is everything. It's everything. So this is why order flow is so important in my eyes. Now, right here, what can we see? Based on order flow, we could see that we were potentially continuing lower right there off of this monthly Verwijt gap. We did not do that. All right, then right now we are disrespecting that. We can head towards this high potentially right there. Perfect. So on the weekly, do we have context? In other words, do we have order flow to continue higher? No. On the daily, do we have something? Yes, on the daily, we have this daily Verwijt gap sitting right there that we can continue higher off of. That order flow that we are having here can lead to having this target, which creates that context from the discount array to that premium array right there. So knowing that, that is now our boundary and target. In other words, number 3 and 4 of the foundation levels, that is the context that we're having right there. Now we can go into the lower time frame to look for lower time frame order flow. So how do we combine the time frames again? On the daily PD array, it was either a 1 hour ST or a 15-minute ST plus RE, like we talked about in the previous video. So here we are first going to go into the 15-minute. And if we go into the 15-minute time frame, then the way it forms is very easily, if you want to have an entry pattern on the 15-minute time frame, it would be an ST plus a RE. That's all there is to it. So it's pretty mechanical in that moment. Now, there might be some details, etc., which eventually you will learn. But in the beginning, it's just an ST plus a RE. So what is that ST and what is that RE? So first we need to understand that a sharp turn, an ST, is only relevant if you are looking at an entry pattern. So an entry pattern, the entry pattern time frames were what again? Those were the daily 4 hour, 1 hour, 15 minutes, 5 minutes, 1 minute. So yes, can you have a sharp turn on the monthly? Well, it could be the same formation, as in the pattern could be the same. But you're not going to count it as a sharp turn because it's not an entry pattern itself. It would then just be called your bias, your narrative, instead of your sharp turn. That is when you can use sharp turn for your bias and narrative, but not for the entry pattern itself. That is very important to understand. So how do we see a sharp turn? We can define it. I'm first going to define it before I show it to you. A fair value gap is a displacement. That's the first thing you need to know. A fair value gap is a displacement. So whenever I refer to a displacement, I refer to fair value gaps. Whenever I refer to fair value gaps, I'm referring to displacement. They're equal, the exact same thing. So first, a sharp turn is again on the entry pattern. It's the entry pattern time frame. That means that we need to have a PD rate to trade off of first. So we first need to have context. The context and that entry pattern. Then once we have context, the PD rate that we want to trade off of, which in this case is the daily fair value gap right there, that is where we can create a sharp turn. So the first step again, then right there is the PD rate. The PD rate that we are going to trade off of. Then into that PD rate, if we are looking at bullish price and we want to see a bullish sharp turn, we want to see displacement into the PD rate, so fair value gaps lower into the PD rate, and fair value gaps out of the PD rate. That is exactly what we would want to see. So that is displacement in, displacement out. PD rate, displacement in, displacement out. That creates a sharp turn. There are 3 different sharp turns. Well, actually, you could say 4. There are different sharp turns where you have textbook sharp turns, not so textbook sharp turns. So textbook meaning they are perfect. They are the exact high probability sharp turns. And you also have very ugly sharp turns, which is all what we are going to go over. So in this moment in time, we have the daily fair value gap. And what do we see? We see displacement, fair value gaps into the daily fair value gap. Perfect. So in the most recent lag that we see right there, coming into the daily fair value gap, we are having fair value gaps in those. That is perfect. That is absolutely great. That is what we want to see ideally. Then after that, we want to see fair value gaps out of it right there. That is exactly what we also would want to see. Fair value gaps out of the fair value gap, again, of that higher time frame PD rate. That creates an ST. So the ST in this moment is this low, which is what we talked about in the previous video, because that is your intermediate term low. That is a sharp turn. Displacement in, displacement out. Why does this work? Well, it's very important to understand how we view the market again, because that leads to rebalance and fair value. Where overall, of course, how I see fair value and how I see fair value gaps is understanding that fair value gaps is intention. So the fair value gaps tell us a story on where we want to trade towards. Yes, that is true. On the lower time frame, fair value gaps are also used for manipulation purposes, purely to manipulate price action. So that is when we create a sharp turn. It's to manipulate price action right there to get people tricked into the market. Because right here, a fair value gap, the high of the bullish fair value gap, is also a low, right? Now, sweeping that low is not super relevant, but that is where we trick people into the market. Because here people think, oh, we're bearish because look at the momentum overall going downwards. Because fair value gaps, again, they also show momentum. They show where price is trading towards very fast. That you don't need to know about a fair value gap to see a fair value gap. As in, you don't need to know that it is a fair value gap. All people that don't know a fair value gap would still see this momentum going lower. We see fair value gaps. So that is where people get tricked into the market. Because it happens fast, it should be going lower, right? So let me place a sell stop right there. Let me place a sell stop, and everything that happens below that, I would get filled lower. So below that low is where I get filled. I'm now in a short. Let me place my stop loss above those recent highs right there. Perfect. This is exactly what I want to do. This is what institutions, big institutions, are doing. They are betting on price going lower based on momentum. They are momentum traders. So we want to trap those traders because we need those institutional liquidities. Again, we, not us, of course. We are very, very small fish in the ocean and we do not matter. But a big battle between the bigger institutions is what we can be a part of course. So right here, this is where people are trapped and we don't want to release them, of course, which leads to then creating a sharp turn, because then we would have bullish those footprints again of the market to continue higher right there, to keep those people trapped. That is exactly what we are looking at. And that is the reason why we use a sharp turn. So a sharp turn is not only a bullish fair value gap, it's both, it's the whole story. Is that PD rate, displacement into it, manipulating, displacement out of it right there. That is exactly what we want to see. Which then creates this sharp turn. And if you want to define the sharp turn a little bit more, it's the most recent bearish fair value gap right there with the most recent bullish fair value gap right there. that created this low. That is your sharp turn. That is our ST. That ST is very much part of order flow. It's very important in order flow because an ST is the first reversal sign of potential order flow flipping. As in, if we are bearish right here, we are bearish overall because overall there was bearish order flow here. Order flow was bearish here. So if we expect order flow to be bearish, well, then when an ST is going against us, that is very tricky, of course. But at this moment in time, we were not expecting bearish order flow because we were expecting bullish order flow off of this PD ray, because we are expecting the daily order flow to just continue higher off of this order flow leg right there. So on the 15-minute, order flow should also switch to bullish, which is the first sign that order flow wants to switch bullish, is that sharp turn. So sharp turn is the first reversal area right there, which is purely based on fair value gaps. Nothing else. Purely fair value gaps. If you are aware of a market structure shift and you trade market structure shifts, again, you can do that. Just know that it's already incorporated into the plan here. So your market structure shift is already bound to happen in what we are going to do. That again leads me back to the house rule of not incorporating anything else besides what we are doing in the mentorship. So that is again how market structure shift has been incorporated into this trading plan. That is very, very important to understand. Otherwise, you're going to waste brain points that you are going to need. So this is a sharp turn right there, which as well, we can even enter sometimes before a market structure shift, which is very, very nice as well. It's pretty cool, actually. So right here, what do we do? Because we had a second part. We had an ST. So the way I see that is an ST plus a re. A re stands for a simple re-entry. So it's referred to, and the way I learned that, or the way I, not necessarily learned because it was through my own understanding as well, but the way it's linked to is to a re-entry. Usually people refer to an original entry and then they have another entry. That another entry is called a re-entry. So it's a re-entry. You're re-entering the market. That is why it's called an ST plus a re. So the re right there, when does that happen? The re happens when we come back into any discount array that created, because we have a bullish ST. So a bullish ST come back into a discount array, trade back into a discount array to create a new fair value gap higher off of that. We trade back into discount array right there, and we create a new fair value gap higher off of that. In other words, you would wait off the ST for a new order flow leg higher. And this right there is the new order flow leg higher, which creates the re. So this right there, that is the re-entry. That is your new order flow leg. So basically what we did right there is you have the sharp turn, and then you, off of that sharp turn, you have a new order flow leg higher. That new order flow leg higher is your entry for a 15-minute ST plus re. After that, it's all good. As in after that, you can just simply follow the order flow legs higher. And those order flow legs higher, which is what we're going to touch on in a later video, those also create your risk management. They also create your stop loss placement. That is very important. So this is the confirmation on the 15-minute time frame. If I'm referring to an ST plus re, this is exactly what I'm referring to. Now, just a quick reminder, we have gone over it as well, but just a quick reminder, an order flow lag is the same exact thing as a short-term range. So an order flow lag is, again, where we have a swing low and a fair value gap being created. Doesn't have to be a swing high, because the swing high sometimes is not created yet. It's just a swing low and then a fair value gap being created. So a swing low that leads to that fair value gap. That is the most important part. If we're having bearish order flow lags, then we have, of course, a swing high and a fair value gap being created. So this is our 15-minute right there. That would be our entry. Stop loss placement, all that stuff is what we're going to go over eventually as well. So that fair value gap would be our entry with the ST plus the re right there. Which if we zoom out, then we can see at the moment of that 15-minute ST plus re happening, we also have a 1 hour ST. Now, we need to understand, if we combine the time frames correctly, we can enter on this 1 hour ST. For the 1 hour ST, you don't need order flow to be confirmed on the 15 minute. As in, you would, again, that leads me back to the same story in the previous video, where the 15 minute ST plus re is there because basically saying, all right, if we have a 1 hour ST, then likely you also have a 15 minute ST plus re. So if you have the 1 hour ST, we already assume that 15 minute ST plus re happened. So we already assume that order flow is confirmed on the 15 minute time frame. Which means that right there, just with a 1 hour ST already means that order flow is confirmed right there on the 1 hour time frame. It's the same with that intermediate term low, intermediate term high story, where the intermediate term low is already confirmed right there. That again leads me back to, how does an intermediate term low get confirmed on the 15-minute time frame? That is a little bit touching on market structure to hopefully clear it up as well, if there were any confusions in the previous video. When we create that ST, so the displacement in, displacement out, that creates a potential intermediate term low. Once we have that new order flow leg higher, that re that is happening right there, that confirms the intermediate term low right there on the 15-minute time frame. Now, this is of course on the 15-minute time frame. That is on the ST plus re-entry confirmation time frame. So use the ones that we talked about in the previous video. Because on the 1 hour, this is already an intermediate term low right there. Why? Because if we have a 1 hour ST, then you already assume that a 15-minute ST plus a re already happened. So that is when this is already an intermediate term low. Order flow is already confirmed on the 1 hour right there. Even though we don't have that re just yet on the 1 hour. Because we are using the time frames as our toolbox right there. That is very, very, very important to understand. So this is one example, but this is one of a few examples that we are going to go over. Now, I want to show you the STs right here, because the ST that we have on the 1 hour, this is for me a textbook ST. A textbook ST, the highest probability ST, is when we have overlapping fair value gaps. So the displacement in and displacement out have the fair value gaps right there are overlapping with each other. As in, they are perfectly right there in alignment. Both fair value gap on the exact same place. That is the highest probability ST to form. But if we take a look at the 15-minute, then we can see that we have this fair value gap right there, bullish fair value gap, the bullish side of the ST, and we have the bearish side of the ST right there. They are not overlapping. Well, you could argue that this right there is overlapping. That right there. So it's still a high probability ST, but the first fair value gaps are not overlapping. That means it's a little bit lower probability. So you could see it as a second tier right there. A second tier ST. Where the first one we had is just perfectly overlapping with the most recent bearish fair value gap and the most recent bullish fair value gap are perfectly overlapping with each other. That's a perfect, picture perfect ST. For example, the ST we create right there. Because we're sweeping that high, which is a premium array, and we have this right there. This is a picture perfect ST again right there. That is a picture perfect high probability ST. That is the overlapping fair value gaps. So let's move on to one more example where I'm going to need the same price action on EU. So right here on EU, we saw price coming down. We saw price coming down right there, targeting the weekly fair value gap that was right there. So overall, we were creating unusual context right here, right? Now we need the usual context to target lower as well. So if you go into the 1 hour time frame, because on the 1 hour time frame, we have this usual context. We have order flow continuing lower right there. We have this high sitting right there. Now on the 1 hour time frame, what was the ST plus the re or just one ST? Those time frames were aligned with the 1 hour time frame PD ray is 1 minute ST plus re or 5 minute ST alone. So let's dive into this price action right there to look at the 1 minute and the 5 minute. On the 1 minute time frame, we can see that we have somewhat of a displacement into it. It's not the prettiest right there, but we can see we have a very small fair value gap right there, and we have a long wick. A long wick also is displacement, because on the lower time frame, that's of course displacement right there. We just have fair value gaps coming into the 1 hour PD ray right there with a very, very small fair value gap. Now, to keep it mechanical again, yes, that is an ST. But we are seeing right here that we have the fair value gap that is being created right there. It's very low. So these fair value gaps that are sitting right there are very far apart from each other, which is of course not very nice right there. Which is of course, again, not very nice. This creates a low probability ST. This is an ugly ST. Now, the ugly ST here is still valid because it's still an ST. It's overall still a sharp turn. That is what we need to understand. That right here, this ST plus what we are seeing is we have this re right there. That is the re. So the ST and the re, two fair value gaps in a low right there. Two order flow lags in a row. That is what you want to see. This is a very, very ugly ST. That makes it lower probability overall. But it does not make it invalid. That is what we need to understand. Because there is one ST which is quite invalid. And that is when we just simply don't have a sharp turn. Which is also sometimes what you will see me refer to. Is if we can find an example. Well, let's see. This, for example, right here is, let me find this right here. If we are coming into a premium rate, now I want you to just use an imaginary premium rate right here. This is just for example's sake. Now, sometimes you will see price action like this. It might not be completely mechanical, but does this seem like a sharp turn to you? No, because we are taking this amount of time. We are taking 40 minutes on a 1 minute time frame before we have the first fair value gap lower right there. Before we create the first fair value gap lower, before we create the first ST lower. Which means that this is of course not a sharp turn on the lower time frame. The sharpest turn on the lower time frame, on the 1 minute time frame, what would happen within 10 minutes? Because that is when we can create two fair value gaps. So this right there is not a sharp turn. This is just a bulky turn. I usually in my forecast, in my breakdown, etc., I refer to this as a bulky turn. When we have a bulky turn like this, which again, that experience and eventually we'll show more examples as well, which we'll get into, that is not necessarily what you want to trade off. This is the lowest probability. This is even lower probability than just an ugly ST. So we have the picture perfect ST, then we have the medium ST, you could call it, then we have the ugly ST, and then we have a bulky ST, which is just the bulky ST is not what you want to trade off of. Now, if we go back to the 1 hour example right here, then this ugly ST is still valid, but it is lower probability. On the 5 minute though, and if we go into the 5 minute, then we can see we have first off this ST right there, which is a very nice ST. Right there, bullish fair value gap and a bearish fair value gap. That ST at that moment in time, once we create that, you do not have to wait for the fair value gap being sting into, right? It does not have to be that entry pattern. The entry pattern, again, where you would exactly enter is also what we're going to go over. Understanding that this right there is already the ST. So that already is what you could enter on. Now, to go over a few more examples right here, let's dive into GBP US dollar. And for GBP US dollar, I'm going to use an example that is sitting right there. On the daily time frame, well, let's start on the monthly time frame actually. On the monthly time frame, at this moment in time, you're seeing the later candle, because that is how TradingView replay works. So at that moment, we were not actually there. We were inside that monthly fair value gap, and on the daily, we had daily fair value gaps lower. That daily fair value gap, which created a daily ST as well right there. So this daily ST could have already been an entry, just purely based on the monthly. just purely based on the monthly, because that is when you need a daily ST or 4-hour ST plus RE, that could have been an entry right there. Now, I do not like to enter off the daily, so I went into the 15 minutes and the 1 hour time frame right there to look at an ST on the 1 hour. I wanted to enter off the 1 hour ST right there. So in that ST, on the confirmation of that ST, we had on the 1 hour time frame another ST that is sitting right there. Bullish fair value gap, bearish fair value gap. This is again a tier 1 highest probability ST because we have those overlapping fair value gaps. That is extremely clean. That is super, super clean. That is absolutely textbook right there. It's very nice. It's a very nice ST. So this again is a picture perfect ST where order flow at that moment in time is again already confirmed. So then we are going to look at one more example, which was Canadian dollar CHF. Now on Canadian dollar CHF, we were looking at the weekly time frame, and on the weekly time frame, we had this weekly fair value gap that we could continue lower off of, targeting the previous week low that is sitting right there. So on the 1 hour time frame, because weekly again, weekly PDRA 1 hour ST plus RE. On the 1 hour ST plus RE that we're seeing right there, we have the 1 hour ST, again, a beautiful high probability ST sitting right there. After that, we create this RE with that new fair value gap lower. That is the RE again. Where would you enter at that moment in time? That is also what we're going to touch on in one of the next videos. So that is where we have the RE, the 1 hour ST plus the RE. Now, of course, understanding as well that at this moment in time, you can also look at this breaker, for example, at the right time. Why am I not using this fair value gap right there to enter off of this high right there and this high and that high? Because it's not involved in time. Time is again the aspect that we are going to go over on later. First, we need to understand price right here. So price came into that breaker. In that breaker, we can also look to now go into the 1 minute time frame and the 5 minute time frame again, if that is in your trading plan. So here on the 5 minute, we had again a very nice ST overall. The ST, the bullish fair value gap, is a little bit higher than the bearish fair value gap. That again creates this ST. So that is again the ST. On the 1 minute time frame, you have a beautiful 1 minute ST coming into it, bullish fair value gap coming into it, bearish fair value gap coming out of it, displacement in, displacement out, creating this 1 minute ST sitting right there. We come back into a premium array and we create this RE that is sitting right there. Eventually new fair value gap, and we trade into that to continue lower overall. This is again the 1 minute ST plus the RE. But Arjo, we didn't even have the 1 hour ST plus the RE yet. So why can you go into the 1 minute time frame right there? This is where if we have again those time frames. So the way we use the time frames is the monthly PDRA. That would be again 4 hour ST plus RE, or the daily ST. For every time frame that we have, monthly, weekly, daily, 4 hour PDRAs, 1 hour PDRAs, 15 minute PDRAs, so 15 minute, 1 hour, 4 hour, daily, weekly, and monthly PDRAs. If you're looking for your entry pattern, you are going to need a 4 hour ST plus RE to enter off the 4 hour. So actually place your order on the 4 hour time frame. Then you are going to need the 4 hour ST plus RE. If you are looking to go into the 5 minute time frame of that 4 hour ST alone, then that is valid. This is where you have the triple confirmation, you could call it. Because right now, or actually it's the same as the ST plus RE. Because if we do the same, clear this up fully, we had weekly PDRA here on Canadian dollar CHF. And we went into the 1 minute time frame once we had a 1 hour ST alone. Right there. We only had a 1 hour ST. This is doable because the 1 minute ST plus RE, or the 1 minute ST plus RE, or the 5 minute ST takes into account that 1 hour ST plus RE. So the 1 minute ST plus RE or the 5 minute ST is the exact same thing as a 1 hour ST plus a 1 hour re right there. So if you're looking to confirm it another time on the lower time frame, that is when you can only use the ST. That is the same thing for the 15-minute ST, where you can go into the 1 minute for your ST, for example. That is the same thing for the daily ST, of course. Inside the daily ST, you can go into the 1 hour to form that ST, to then look at that 1 minute ST again. So you can get very creative with the time frames. You can constantly confirm it again. Now, do we need that constant extra confirmation? No, but this becomes a sort of preference. So I'm telling you all the options that you have right here. Where I do not like to enter of a monthly PDA with a 4 hour ST plus re, simply because I don't like to enter off of the 4 hour. So what do? I go into that 4 hour ST to look for my 5 minute ST plus a re, or the 15 minute ST, if I feel like it. That is exactly what I do. Or what I also tend to do right there is I look at monthly and the daily ST. I mainly use the 4 hour ST plus re right there. And if I'm using a different trading plan, a flow trading plan, which is also what we're going to go over on, then I can look at, all right, 1 hour right there of a weekly PDA, 1 hour ST. Perfect. I do not want to wait for that re. So what do? Inside that 1 hour ST, I go into the 1 minute ST plus re to confirm that 1 hour re that was about to form. Because here you can again see the same thing where we now have this 1 hour re right there. Inside that 1 hour re, what happened? We had a 5 minute ST and we had a 1 minute ST plus re right there. So the 1 minute ST plus re and the 5 minute ST are the same as your 1 hour re right there. So it's the same exact confirmation, just on different time frames. So that exactly is how you can go over that. And it's again that order flow story, understanding that order flow story on the lower time frame. This is again the basics of order flow. You can understand this, then we can move on to the next videos, which are going more in depth on order flow as well. All right, perfect. Thank you.